All right. Thanks everyone for joining. Excited to have you here for our webinar on irrevocable life insurance, different funding strategies, and really it's how do you optimize your insurance policy when you put it in a trust based on the type of trust it is and the funding strategies. We're going to give people 2 minutes to join before we get started. In the meantime, please let us know where you're joining from. Peter, you want to start with where you're joining from?
I'm in Los Angeles.
Nice, warm and sunny. I'm in the Northeast in New York. East Bay, Pittsburgh, nice. Fort Lauderdale. I moved up from New York from Miami, so very familiar. And actually heading back down next week. Excited for the warmth. North Carolina, San Francisco.
Mani used to live in San Francisco.
Yes, I lived. I was a San Francisco resident pre-COVID, so do love. Used to live in North Beach. All right, we're going to get started. So first of all, I want to thank everyone for joining. Really appreciate everyone taking the time. Today's webinar, it's going to be about how you really optimize your life insurance policy when you put it in an Irrevocable Life Insurance Trust, or ILIT. You're going to probably hear us use that acronym a lot. It's just shorthand for Irrevocable Life Insurance Trust. We'll get into what that specifically is, but it's really how do you optimize paying for the policy premiums in these ILITs based on the type of life insurance policy that you have. And before we get too deep into that, just want to give a quick introduction on Valur and Peter and I. So Valur, the whole idea of Valur is to help everyone build their wealth more efficiently and really focus on how do you mitigate taxes, whether it's ordinary income, capital gains, estate taxes. And we help people understand what are the different options for these different types of taxes with content. We have a lot of written articles, as well as webinars like this. In addition, we also have a lot of tools where we can, just by answering a few questions, we can help you figure out what problem you're solving for, what are the best practice solutions, as well as the quantitative ROI of those solutions, as well as qualitative benefits and trade-offs of those solutions as well. And then, Peter, do you want to give a quick introduction of yourself?
Yeah. So my name is Peter Cucci. I am the head of estate planning at Valur. I'm actually a trust and estates attorney by background. I joined Valur about a year ago from a law firm, and so I'm kind of heading up the estate tax side, which includes ILITs and other irrevocable trusts.
Yeah, and I'm Mani Mahadevan. I founded Valur. A lot of this was based on a personal situation where I was fortunate to be part of a startup that did well. When I lived in San Francisco, actually, and the joys of high taxes that many people on the call face, really I was trying to figure out how do I maximize my exit, which came down to minimizing taxes. And I just found it was, one, hard to understand what are the options. Two, and then once you understand those options, really understand what's the impact and value of it. And then finally, today's world tends to be expensive, slow, hard to understand to set these up and utilize these structures. Really started Valur with the premise of how do we use technology to make it easier to understand, set up, and really utilize these structures in the best way possible to help build your wealth more efficiently. So it's not just family offices and billionaires utilizing these strategies. So let's get into it. What are we going to talk about today? Today we're going to talk about just starting with the basics of what are the basic types of life insurance, its purpose, as well as what are irrevocable life insurance trusts, or ILITs. How do ILITs work? We're going to assume people on this call are more familiar with the purpose of life insurance and how it works. We'll kind of give some basics, but taking that for granted. And then we'll jump into kind of what are some of the key benefits and trade-offs of ILITs? Why do people utilize them? And then really get into really our goal is, how do we help people understand, how do you optimize, and what are the different strategies to optimize the ILIT and your life insurance policy in terms of funding it to maximize what your family gets and minimize taxes? And then jump into a case study to help kind of illustrate what is the financial impact of that. Kind of a quick preview is you can kind of double what your family gets from your life insurance if you properly utilize ILITs and how you fund those. The final piece to call out is, please ask questions. We love to see questions. Put them in the chat. We try to answer them fairly close to real time, or if it's applicable to the topic we're focused on, or if not, we'll bring it up when it's applicable or save it for the end. So let's get started here. Let's get started with the basics of, Peter, why don't you just kind of quick overview of life insurance and different types of policies?
Yeah. So there's a bunch of different types of life insurance policies. The sort of two general categories are term and permanent. So term insurance is like probably what you think of as life insurance, like the most common type of life insurance. It has a discrete term. So, you might get a 20-year policy. And if you're 40, it'll last until you're 60. And then when you're 60, the life insurance policy, if you show live, life insurance policy expires, and that is that. Permanent policies are a little bit different. They're not just policies that last for a term. They're policies that last for usually the rest of your life, or at least as long as you keep the policy in place. Oftentimes, permanent policies also have some kind of investment component involved. And so it's not just a death benefit. It's not just like a $5 million death benefit that you're paying annual premiums for. There's also some kind of investment component, and that investment component can be really tax advantaged because life insurance under federal law isn't subject to income tax, basically. So.
Yeah, and it's a really good call. And I think just also thinking about this use cases is because term is one, it's fixed, and it's also, you may or may not get it depending on, no one, knock on wood, wants to pass away during the term of their life insurance. In many cases, it's a hedge against something happening to you to provide for your family. Is that fair, Peter?
Yeah, it's a hedge against sort of, the worst case scenario of you dying prematurely.
You're getting hit by a bus, right? Yeah. Like the proverbial bus there.
But the plan is that it's never going to pay out, because if it pays out, that's actually that's a bad thing, because it means that you die.
Yeah. While on the other hand, permanent can actually be a tax mitigation vehicle because of that investment component when you combine that with the tax advantages of insurance. We're not going to go too deep into that, but it can be a tax, whether it's an ordinary income, as well as a state tax mitigation strategy on its own. And for the kind of tax and estate mitigation, a popular version of that is what's called private placement life insurance. We have other webinars on that we can share, but that's just kind of the high level. Now, maybe let's get into kind of what is an irrevocable life insurance trust, Peter?
Yeah, so an irrevocable life insurance trust, I mean, actually the name is pretty descriptive. So it's an irrevocable trust that you create in order to hold life insurance. And so it has provisions that are sort of specific to the life insurance statute, part of the estate tax laws that cover life insurance. And the basic idea is that instead of owning a life insurance policy in your name, you can have a life insurance policy that's on your life, but actually owned by an irrevocable life insurance trust. And what that does is it gets the policy and the death benefit out of your estate. So there's no estate tax when you die on the death benefit. If you didn't have a trust, what would happen is, assuming you're subject to estate tax because you're over the exemption amount, which we can get to, without the trust, the entire amount will be subject to estate tax, and the estate tax is 40%, up to 52%, depending on what state you live in. So it's a pretty substantial tax bite.
Yeah, and we'll focus on. We'll start with there's tax benefits and asset protection benefits of using ILITs. We'll spend a little bit more time on that in a couple minutes. But let's maybe start with just kind of the basics of how does an ILIT work, and kind of just what are the steps, and just make it really. We want to just make sure people understand the difference between that and owning a policy yourself. So maybe people want to run through this.
Yeah, I mean, it might make sense to sort of provide a little bit of brief overview of the estate tax.
Yeah. Maybe let's start with what is the gift and estate tax for folks who.
Just to kind of frame it. So there's a lot of people have heard of the estate tax. Maybe you don't know the details, but the basic idea is there's a federal tax, and 12 states and DC also have state level taxes. But there's a federal tax of 40% when you die on all of your assets above the lifetime exemption amount, which is currently $13.99 million per person. So most people are not going to be over the exemption amount. Like your typical middle class person is not going to have $14 million when they die. But for more high net worth people, if you are going to be over the exemption, everything that you own in excess of the exemption amount is going to be taxed at 40% by the federal government, even if you live in Texas or Florida. And then, if you live in New York, there's an extra essentially 10% on top of that. And other states have even higher state taxes. So it's a pretty significant chunk. And so if you're looking for ways to, or if there are ways to avoid that tax on your death, like an ILIT, it can be pretty powerful.
And let's actually just jump straight to what are the benefits, the key benefits and trade-offs of an ILIT.
Yeah. So the key benefits. So this slide shows them. But so the really big benefit and the reason most people do ILITs is really the estate tax benefits. So as I was saying, the death benefit inside of the ILIT is not considered part of your estate for estate tax purposes, assuming the ILIT's set up right. Whereas if you own the policy in your own name, it just pays out to your kids or your spouse or whoever, then that's going to be includable in your estate. And so, if you have a $20 million estate and then, a $5 million death benefit, that $5 million death benefit is going to be subject to at least a 40% tax on your death. So it's going to be taxed pretty heavily. So state tax is a big driver. And then tax-free growth. So this is really a reason why a lot of people who are worried about estate tax get certain types of insurance policies. It's a way to sort of take advantage of these income tax benefits that insurance receives. Life insurance policies or any investments that they own are not subject to income tax. And so it's a way to sort of stack those income tax benefits on top of the estate tax benefits that ILITs already offer.
And I just want to
also a bunch of other sort of non-tax benefits.
Yeah, I just want to just hit on those first two. Just the estate tax benefits. The estate tax benefits. This is where really the value of the ILIT, right, is instead of you personally owning your life insurance policy, by moving the life insurance policy to be owned by the ILIT instead of you're moving it outside of your estate. So then you can avoid those estate taxes. The tax-free growth. This is from the life insurance. Just to kind of make that piece clear. And so we can get into these other benefits, but within these kind of tax side, the ILIT is providing the first piece, the insurance is providing the second piece.
Yeah, and then so the other benefits, the sort of the two of the really obvious non-tax benefits. So one is the trust provides asset protection. So that's pretty significant for a lot of people who are worried about asset protection. And then two, it provides a convenient source of liquidity. So one issue that people have is, so some people have estates that consist largely of illiquid assets, like maybe real estate or shares in a private privately held business. And so when they die, they're subject to, several $1 million of estate tax. Sometimes there are ways to defer some of that tax if you have liquid assets. But basically, what insurance does is it provides you with a ton of cash right after it provides your family with a ton of cash right after you die, and so that cash can be used to satisfy the estate tax obligations that your family has. And then there's other reasons why your family might need liquidity on your death. Maybe they just need liquidity to fund their lifestyle or something, and so it can be helpful there as well.
Yeah, and the piece I want to call out is like some of these things. For instance, the estate tax benefits. Again, as Peter mentioned, the estate tax is currently individually your exemption's about $14 million. That number is set to get actually cut in half. We'll see if there's political changes, so that may change. But right now, as of next, that would become $7 million. So there's a piece of if you have or expect to have more than that, this is really where the estate tax benefits become valuable. And this is also where, there's a lot of overlap. Those tend to be also people that are worried about asset protection because they have more to lose. And so the value of moving some of that value outside of your name to, one outside of your estate and outside also to a different entity, so that if you get sued or have creditors, you're able to protect those assets for your kids and future generations. And that's kind of a big part as to why people use ILITs. And let's go kind of just back to, and please let us know if there's any questions about these benefits or kind of the use cases. But really the core one is, if you're worried about estate taxes for ILITs or asset protection, this is really when people will, and obviously you need kind of life insurance to make an ILIT make sense, what goes without saying. Let's get into kind of how does an ILIT work?
Yeah. So the basic idea is that you set up the trust, you draft and execute the trust, and then once the trust is up and running, either you transfer the policy in or you purchase the policy inside of the trust. But basically, you need the ILIT to be both the beneficiary and the owner of the policy. And so usually what happens is people set up the ILITs right before they're going to get an insurance policy on their life. And then they put that policy, they put the policy inside of the ILIT. And so it's never transferred in. It's just always there. If you do transfer the policy in, it's a little bit tricky because there's a special rule around, there's a few rules around transferring policies to trusts, existing policies. The basic idea is that they don't want people who are about to die transferring policies into trusts. And so there's a 3-year sort of like waiting period before you get the estate tax benefits if you transfer an existing policy. If you buy the policy inside of the trust, there's no 3-year waiting period. So
yeah, and so another way to say this is you can get these benefits as long as you're not, kind of on the edge or think you'll pass away. There is some seasoning needed if you do have a policy, but you can move it in and get these benefits. But if you're thinking about getting a policy, it's kind of it may be a good fit to utilize it. And then there's often the question of, okay, if you don't own this policy yourself, the trust owns it and is the beneficiary. The trust doesn't, you may have an income source, you may have assets. How does the trust pay for it? Right?
Yeah.
Like we'll get into that in a second, but that is kind of it. And how you do that is how the trust gets money or pays for this really depends on the type of insurance policy you have. Going back to kind of what we first talked about of depending on whether you have a term policy or permanent, there's different optimized strategies for that. And then I guess the final piece here is if the trust owns the policy when the insured person passes away, the trust gets those benefits, whether it's a term or permanent, it is going to get those benefits paid out to the trust afterwards. And this is the key, is because it's outside of your state, you're able to avoid estate taxes on it, as long as Peter mentioned, as long as you've passed it on more than 3 years before you passed away, unless you purchased it inside.
Yeah, in most cases, the 3-year rule doesn't matter because usually the trust is set up and then the policy is acquired inside of the trust. So
yeah, what we really want to focus on today is how do you really optimize ILITs and the policy here with how do you pay for the policy premium? And the answer is it really depends on the type of policy you have. Maybe Peter, let's start with what kind of just how do policies compare between term and permanent life insurance?
yeah, so the big, a few differences, but a big difference in terms of funding the premiums is so term policies tend to have pretty small premiums relatively, and so depending on the size of the death benefit, depending on your age and health and whatnot, you might have a term policy where the annual premiums are like $10,000, $20,000 a year. And that's like a pretty small manageable amount to pay. On the other hand, there's some permanent policies, particularly what's called PPLI, which stands for Permanent Placement Life Insurance, which is a popular type of life insurance for people who are looking to build up a lot of have a large investment component in their life insurance policy. It's used a lot for people who are doing estate tax planning inside of ILITs. Those policies tend to have enormous premiums, but it's usually only like 5 years of premiums. But it might be like $1 million a year for 5 years. And so for those, you need a pretty serious source of liquidity. It's not just little checks each year. And so there's sort of two big picture ways of funding an ILIT with the money it needs to pay premiums. And so one big picture idea is you just say, that the premiums are $1 million over the course of how many years. I'm just going to contribute, around $1 million up front. And then the trust will just, pay the premiums from that liquidity each year, and then you can always add more cash in the future if it needs it. But and so that's sort of like the big picture, sort of idea one. So either you fund it with a bunch of cash or securities up front, or you fund it with like maybe real estate or some kind of income producing asset, and then you say I'm going to pay the premiums from the rental income or something like that.
And a key piece to call out here, right, is this can use up, we mentioned the lifetime gift exemption. This is going to either use up likely a large chunk of your lifetime gift exemption or potentially cause gift taxes if you've already used your lifetime gift exemption.
Yeah. So in most cases, people setting up ILITs haven't used, or like ILITs that are using that require significant premiums. Most of these people haven't used their lifetime exemptions, and so it'll just use up a portion of their $14 million exemption.
Yeah, exactly. The typical is that you haven't used it up, but you will use it up, which means that you have less remaining. And then this goes to the second option, which typically doesn't use up any of your lifetime gift exemption.
Yeah. So the other strategy is to pay the premiums every year, to make contributions to the trust every year. So if you know that the premiums are due in July, every May or June, you make contributions to the trust of an amount that's sort of close to what the premium is going to be. And then the trust just uses that amount on an ongoing basis to pay those premiums. And so this is more common when the premiums are lower. And part of the reason for that is that most ILITs are set up so that they're what's called crummy trusts, which means they're trusts where you can make annual exclusion gifts.
And how much is the annual? What is the annual exclusion?
Yeah, so I was going to say that. So you can gift an individual $19,000 a year without using any of your $14 million lifetime exemption amount. And so if you have 2 kids, you can gift each of them $19,000 a year. And so that's $38,000. If you're married, you and your spouse can each gift them $19,000 a year. So if you're married with 2 kids, you can gift them $76,000 a year, 19,000 times 2 times 2. But what you can do is, instead of giving the money to the kids directly, you can set up a trust called a crummy trust that gives the kids the right, at least in theory, to withdraw that amount. And basically, by giving them those withdrawal rights through the trust, you make the trust eligible for the annual exclusion. So the basic idea is, let's say you have a term policy, and you create an ILIT. It's for the benefit of your 2 kids. You put the term policy inside of it. The annual premiums are $25,000 a year. You can just make $25,000 gifts to the trust each year, and those can be annual exclusion gifts, so they don't use any of your lifetime exemption amount, and the trust will have enough money to pay the premiums itself.
Yeah, and let's just say you have 3 kids and 2 grandchildren who are the beneficiaries of your ILIT. How much could you, with this annual exclusion, fund your life insurance policy with?
Sorry, how many kids did you say?
3 kids, 2 grandkids, 5.
Yeah.
Make it complicated.
So it would be five beneficiaries. If you're married, you double up, so that's 10. Each of you and your spouse get 5, and so that's 10 annual exclusions. And so it's $19,000 times 10, which is $190,000.
And so this is where, as kind of on this slide, typically annual exclusion gifts are used to fund term policies because it's smaller amounts versus in permanent. As Peter mentioned, it's a large bulk up front. But this is where, if you have a lot of kids, you're married, you can actually, $190,000 per year without using your lifetime gift exemption can add up to be pretty significant. And you can actually, potentially build up enough to actually fund a permanent. But that's one dependent on having a lot of beneficiaries, having a spouse to be able to make those numbers work.
Yeah.
But in most cases, you can fund a term with these annual exclusion gifts, protect your lifetime gift exemption. With a permanent, it'll often take pre-funding the trust with larger assets, but there are times where you can make those annual exclusion gifts work, as we're kind of mentioning there. Now, there's really kind of like, there's one key thing that you really shouldn't do to how to pay for these ILIT, the life insurance premiums that are inside of an ILIT. Do you want to kind of explain why you shouldn't pay them yourself?
Yeah. So a couple of reasons. So what happens pretty often, I would say, is that people set up the ILIT correctly, but then instead of having the trust pay the premiums, they just write a check to Lincoln or whatever the insurance company is themselves each year, and so that they're directly paying the premiums. And so, a couple issues. So one, that's going to be those premium payments are going to be taxable gifts. So they're going to use a portion of your lifetime exemption. Whereas you could have used annual exclusion gifts probably instead. And so it's not super efficient from a gift and estate tax perspective. And the other thing is just you want to create as much space as possible between the grantor of the trust and the trust, so that there's no estate tax inclusion arguments that the IRS can make. So that the IRS is going to want to try to argue that you never really transfer the policies to the trust.
Yeah, it's in name only.
Effectively owned by you, and so paying the premiums themselves probably isn't enough to cause estate tax issues. But I think that if you're paying the premiums and doing other stuff, it could sort of paint a picture of you never really, like, the trust never really owned the policy. It was really owned by you, and so you want to sort of create as much separation between you and the ILIT as you can.
Yeah, there's a couple of questions. I'll start with there's one of, and Michael also has a similar question of, what if there's insurability things? Essentially, is if there's a problem getting life insurance, it's an entirely separate thing of like, can you get that? The ILIT isn't going to make sense unless you can get life insurance, right? There's other structures you can use for estate taxes, like, it's same structure, but called crummy trust, etc. But really, the ILIT only makes sense if you can get life insurance. And in this question, is there a typical kind of age, Peter? You may not have the answer as to when
it
it's too
depends
late.
on the policy. I would say usually if people are under 60 and they're worried about estate tax, they can find a decent policy. So like term policies, usually like a 6-year-old wouldn't be getting a term policy. But some of these other types of policies like PPLI can still make sense for people like in their 50s, definitely 40s, but even people in their 50s, they can still make sense because they're actually like less focused on death benefit and more focused on the investment components. And so like the death benefit piece is actually relatively small. And so even if, the death benefit would be relatively expensive, it actually wouldn't be that bad in sort of the grand scheme of things.
Yep. Yeah. So that's kind of a piece here. There's another question from John before we get into this case study of if rental real estate is covered. So essentially the income, so option one here, you're pre-funding this with the real estate that generates income to pay for the premiums. Is there a 1041 step up, and who pays the accumulated depreciation when the real estate is sold?
So the trust is outside of the trust is outside of your estate. And so if you died with the trust owning the real estate, there's no basis step up. There's a couple of things here though. So one is anytime, so that the ILIT would be what's called a grantor trust, which is ignored for income tax purposes, although it doesn't qualify for the basis step up. It's ignored for income tax purposes. And so one thing that you can do is, let's say you transfer real estate to an ILIT, 10 years ago, and now it's really appreciated. And you think, what if I die? I'm not going to get basis step up on the real estate. What you can do is you can swap it out for a different asset. Essentially, you buy back the real estate from the trust in return for something of equal value. And so what you would do is you get the real estate appraised. It's appraised for $5 million. You pay the trust $5 million for the real estate. The trust gives you the real estate back. And so now the real estate, which is appreciated, is back in your name. And so if you died, you get a basis step up. And the trust now has $5 million of cash or stock or whatever it is that has a higher basis. And so there's ways to mitigate that. The other thing is I just use real estate as an example. I have seen people use real estate in ILITs. It's not super common. There's other income producing assets though. You could have, some kind of like private credit or something that's throwing off income. Some other type of investment that's throwing off consistent income.
Let's go into kind of the we'll get into just kind of a case study as to what is the benefit of properly using an ILIT that we've called out here. So take the scenario of Jack's a single father, lives in New York. He wants to pass on as much as possible to his kids and expects to fully use up his lifetime gift exemption with other assets and other gifts to his kids and grandchildren. So he's taking out a $6 million term life policy with about $35,000 of annual premiums. So really kind of two scenarios of he can own the policy himself, or he sets up an ILIT and has the ILIT own the policy. So let's assume he passes away during this term. If he doesn't pass away, obviously he doesn't want, again, to our earlier piece, he doesn't want to pass away. But if he doesn't pass away, there's no financial implications here. But if he does pass away, during the term, that $6 million policy does pay out. And even though that's the same life insurance policy that pays out the same $6 million, there's very different financial implications for Jack's estate and his kids based on whether or not he owns it or his ILIT owns it. And maybe Peter want to walk through kind of what happens in the scenario where Jack owns it versus the ILIT owns the policy.
Yeah. So in New York, New York has its own estate tax, and so the effective New York / federal estate tax rate is almost 50%, 49.6%. And so what happens in this example is if Jack owns the policy personally, he's going to be over the exemption amount. So half of that $6 million death benefit is actually going to be basically for the government, and half is going to be for his kids, which is obviously not ideal. If he'd set up the if he set up the ILIT and had the ILIT on the policy instead of himself personally, then the full $6 million would be outside of his estate, and that $6 million would go into the trust for the benefit of his kids. So it's a 100% return difference, 3 million versus 6 million.
Yeah, and this is really the value of one is how do you use the ILIT to get outside of your estate, and then really using those annual exclusions. And this is where it may seem small, whether you put it in the ILIT or not, or use your annual exclusions, but it really does add up over time. With almost everything financial, it always comes down to compounding, and these things do compound to get a really significant, in this case, $3 million or 2x difference. So we'll jump into just want to say, so one, appreciate everyone joining us, and there's a couple of questions we'll get to, but we hope this is helpful. Please let us know in the chat if you have other questions on this. You can also visit us at valur.com or learn.valur.com, or email us directly, or schedule time with us at valur.com/schedule. We want to help people understand these structures, how to best use them, and really how to optimize it and make it easy to access, utilize, and really build wealth for you and your family. And also, please join us. We have webinars every week at this time. Our next week's webinar is also on an estate tax topic of how to decide which assets to gift to trust for your kids, and really how to optimize deciding between which assets for people that are worried about estate taxes. And then the following week, we're going to be talking about beyond DAFs and really what charitable structures make sense for what you're solving for. DAFs have become really popular over the last decade, and the reality is they're good for some scenarios and not great for other scenarios. We really want to help people understand what are the charitable structures out there, how do those benefits accrue to you, your family, versus the charity, and help you understand what's the right fit for based on what you're solving for. We'll jump into some questions now. Sam had a question of, can an ILIT purchase a viatical as a substitute if an insurability problem arises? Good question.
Yeah. So what you see more often is the trust selling the life insurance policy. So this is what he's talking about is, can you purchase like somebody else's life insurance? So sometimes people have a life insurance policy, and for whatever reason, maybe they don't want to pay the premiums or something. They decide they'd rather sell their policy to a third party. And so a third party can purchase the policy from them. So what happens a lot of times is people decide after 25, 30 years of having the policy that they no longer want it for whatever reason, and they'd rather just have cash. And so they want to cash out, and so they sell the policy. I see this a lot with the trustees of ILITs deciding that it no longer makes sense to own a policy that they purchased in the 90s or whatever. I don't really see trusts purchasing viaticals. I think you could. Honestly, I don't know why you wouldn't be able to, but it probably. I'm guessing that if you run the math,
you're not going to get much of a difference on the valuation spreads, right? And enough to you're probably getting less of the benefit there.
Yeah, I mean, you could do the math, and if you thought that the return was really high, I guess you could do it. But yeah, I mean, more often people are investing in like private credit or other types of investments. Yeah, I mean, so if you personally purchase a life insurance policy on somebody else, it's just like any other asset. It's either in your estate if you purchase it personally, or it's outside of your estate if it's inside of the trust. But there's nothing really special about it. It's really just like any other type of investment. So.
I got a direct message if someone's wondering how to have an idea if something like permanent or life insurance and ILIT can make sense. So I just want to quickly share, we have a lot of free tools at Valur, just the content, these webinars. I want to share we have this tool. So if you are worried about estate taxes, we have these tools for capital gains, ordinary income, estate taxes that help you understand the different ROI and liquidity of these different structures. So these are common estate tax structures. This is at app.valur.com under compare estate tax savings. And you can choose these structures here. I'm going to choose an ILIT. This kind of presumes that you have insurance. You can fill out this key information as to how old you are, where you live, net worth, kind of all these things, expected growth rates. We'll make this a little bit higher. And what you can actually see is what is the value of these different structures, including the estate tax savings. And so we can see in this scenario is actually the ILIT will create the most wealth. And so there's just one way if you're wondering, can this combination make sense? Here is kind of one way to help size what the value of these structures, as well as some of the different numbers and liquidity over time and the different qualitative trade-offs and where you can deep dive into it. So we have these types of tools, as well as even if you want to take a step back and figure out what's the right problem to solve for, we have what's called this guided planner, where you can help figure out as to what structure or what problem are you solving for, answer some basic questions to help understand what's the type of, what are some of the solutions, as well as the trade-offs and benefits on these. So that's just, if you're not even sure where to get started or if this makes sense, this is kind of one good one way to get started. And we'll include this in the follow-up email if you have questions on it. So outside of that, really appreciate the time and everyone taking the time to join us. And please let us share any feedback that you have or any other topics that you're interested in. And we're hopefully looking forward to seeing most of you next week.